Nvidia is the undisputed king of AI hardware. We all know that. But while the entire market is intensely fixated on the GPU wars, a $247 billion networking company is quietly threatening Nvidia's proprietary Moat with a hidden $6.2 billion weapon. The tension here is absolutely massive, because to understand who is actually going to dominate the next phase of artificial intelligence infrastructure, we have to look past the compute chips and focus entirely on the network wiring them all together.
That staggering $6.2 billion figure isn't a pile of cash sitting in a bank account, and it definitely isn't an acquisition fund. It's Arista Networks' deferred revenue. To put this into perspective, in the highly cyclical, wildly volatile world of physical hardware, having a massive, locked-in backlog of products that have already been ordered is practically unheard of. Hardware is usually a boom and bust business. But for Arista, this $6.2 billion acts as the ultimate financial buffer. It gives them a level of earnings visibility that allows management to plan years in advance, effectively shielding their balance sheet from short-term macroeconomic shocks.
And this brilliant deferred revenue shield is actually growing rapidly right now because of a very specific, high-stakes conflict playing out inside the data center. Nvidia wants to lock the entire AI industry into its proprietary InfiniBand networking protocol. They want to own the whole stack, from the GPU computing the data down to the actual cables and switches moving it. But the hyperscalers, the Microsofts and Metas of the world, are actively fighting back. They are desperately deploying Arista's open-source Ethernet to break free from that single-vendor lock-in, which allows them to scale out their massive data centers on their own terms without any restriction.
So let's explore the $6.2 billion AI nervous system.
To understand why this battle matters right now and why the market is pricing Arista at such an elite premium, we have to look at how this business actually functions beneath the surface. They don't just sell simple hardware routers and walk away. Arista operates through three highly integrated core divisions. First, you've got core data center networking. This is the heavy lifting. This is the AI spine, handling massive 1.6 terabit systems that route petabytes of data between tens of thousands of GPUs simultaneously. If this network drops packets or lags for even a microsecond, a $1 million AI training run is completely ruined. Second, there's cognitive adjacencies. This is their aggressive push into enterprise campus environments and secure SD-WAN routing. Essentially, they're taking the high-performance tech they built for the cloud titans and selling it to Fortune 500 companies to wire up physical office buildings and branch networks. And third, you have the highly profitable Cognitive Networks division, which handles software and services. Now, the absolute genius of Arista's business model is that all of these divisions run on a single, brilliantly designed operating system called EOS. Historically, networking companies would acquire different businesses and end up with 5 or 6 fragmented operating systems. It was a total nightmare for IT departments. Arista doesn't do that. No fragmented software, no vendor lock-in, just one unified, programmable brain for the entire network. Network engineers learn EOS once, and they can manage the entire stack. This means the switching costs are incredibly high. Once an IT department is trained on EOS, they literally refuse to rip it out. And by the way, if you like deep evidence-based stock breakdowns like this, make sure you're subscribed.
So, let's look at who is actually buying this infrastructure, because the customer concentration here is vital to the story. Nearly half of their 2025 revenue, 48%, came directly from the cloud and AI titans. We're talking about the absolute behemoths of the tech world, specifically companies like Microsoft and Meta, who are building the world's most massive generative AI training clusters. These companies literally cannot afford downtime, and they are blanketing their data centers in Arista gear. Another 32% came from high-performance enterprise accounts, which gives a nice, slightly counter-cyclical stabilization to the business. And the remaining 20% came from emerging AI and specialty neo-clouds, those aggressive upstarts trying to rent out GPU access. The demand for the physical plumbing of the AI revolution is heavily concentrated right here, making Arista a pure play on AI infrastructure spending.
Which brings us directly to the threat to Nvidia.
This central conflict the market is currently trying to price in is the battle for the back-end AI network. Arista's true competitive moat lies in exactly what they choose not to do. They completely avoid building custom proprietary silicon chips. Instead, they leverage a massive merchant silicon advantage. They buy the absolute best off-the-shelf networking chips from companies like Broadcom, and they pair that raw hardware with their deeply ingrained EOS software. Let's unpack why this is such a game changer. Nvidia spends billions of dollars on R&D to design proprietary InfiniBand chips. Arista lets Broadcom foot the R&D bill for silicon innovation, while Arista focuses 100% of its engineering talent purely on system design and software optimization. This lets them iterate incredibly fast and keep costs down, delivering the open, standards-based scale that cloud providers absolutely love. Plus, Arista's leading the Ultra Ethernet Consortium, a massive industry group dedicated to making Ethernet perform just as well as InfiniBand for AI workloads, which structurally protects Arista from being locked out of multi-vendor environments.
CEO Jayshree Ullal perfectly summarized this dynamic, stating that customers are prioritizing high-speed Ethernet as the central nervous system of their AI fabrics. Think of it like this. The GPUs are the brains, doing the heavy computation. But if the nervous system is slow, the brain just can't function. Hyperscalers need sub-microsecond latency to prevent wildly expensive Nvidia GPUs from sitting idle while waiting for data. By providing an open standard that performs just as well as proprietary tech, Arista presents a direct existential threat to Nvidia's ambition to own the entire data center stack.
All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, which are quality businesses built to compound for years; hidden gems, offering under-the-radar names with asymmetric upside; and dividend hunters, providing durable income with the fundamentals to back it up. Portfolio Watch monitors your portfolio and flags important changes, and Insider IQ tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. Let's look at the Q2 2026 earnings evidence.
The strategic story and the competitive moat sound fantastic in theory, but the real question is whether this open standard strategy actually translates into financial dominance on the balance sheet. Well, the evidence is undeniable. In their blowout Q2 2026 earnings announced on August 4th, they crossed the $3 billion quarterly revenue mark for the very first time in company history. That's nearly 38% year-over-year growth. They crushed analyst EPS estimates by almost 16%, coming in at $1.02 per share. But the crucial point here, the number that absolutely separates them from the pack, is that non-GAAP operating margin of 49.9%. For a company heavily involved in bending metal and shipping physical hardware, producing margins of essentially 50% is mind-blowing. Traditional hardware companies fight tooth and nail for 20 to 30% margins. Arista is achieving software-like margins because their EOS software is the true value driver, creating a staggering display of structural operating leverage. And they didn't just beat the quarter looking backward. Management confidently raised Q3 guidance to $3.3 billion, which easily topped Wall Street consensus. This forward-looking confidence completely resolved previous market fears regarding supply chain bottlenecks. The market's reaction was swift and violent. The stock surged roughly 13% immediately following the print, forcing analysts across Wall Street to aggressively hike their price targets up toward the $200 to $210 range. This incredible operating leverage is exactly why the qualitative scorecard rates them a massive 9.1 out of 10. When you synthesize this business, they are the very definition of an elite secular compounder. They achieve perfect scores in market position and financial health, and it's completely driven by absolute financial dominance. They possess a pristine balance sheet with absolutely zero long-term debt. Let that sink in for a second. A massive infrastructure company with zero long-term debt. Furthermore, they generated a record $1.69 billion in operating cash flow in a single quarter. That allows them to easily self-fund their immense working capital needs without ever having to rely on expensive external financing or diluting shareholders.
So let's explore the 5-year scenario framework.
With the stock trading near all-time highs at roughly a 56 times forward multiple, the expectations are clearly elevated. So we need to map out exactly what has to happen operationally and mathematically over the next 5 years. But first, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. Let's deeply break down the mechanics of the next 5 years, because the delta between these outcomes is huge. Starting with our probability-weighted base case, this points to an implied value of $332 per share. For this to materialize, Arista needs to compound its top-line revenue at a steady 18% annually to hit $20.6 billion by the end of the decade. Operationally, this assumes that the AI infrastructure build-out remains strong but matures into a more predictable upgrade cycle rather than a frantic gold rush. It requires them to maintain a 38% net margin while the market grants them a 51 times earnings multiple. If they execute this smoothly, investors are looking at roughly an 11% annualized return from current levels. But what about the low case? The bear scenario implies the stock could plummet to roughly $121. This is the hardware hangover scenario. If hyperscalers like Microsoft or Meta drastically cut their capital expenditures, maybe because AI software revenue isn't materializing fast enough, demand for Arista switches will evaporate. Furthermore, if cheaper, white-box networking alternatives begin stealing market share, our low case projects revenue growth slowing aggressively to just 12%. Net margins would compress, and Wall Street would completely strip them of their premium valuation, crushing the multiple down to 30 times earnings. Conversely, the high case, the true bull scenario, implies a massive upside to $512 per share, or a staggering 21% annualized return. For this to happen, Ethernet doesn't just compete with Nvidia's InfiniBand, it completely replaces it inside the back end of AI networks globally. Open standards achieve total victory. In this reality, Arista software subscriptions become an even larger piece of the pie, driving net margins up to a highly profitable 41% on $27.4 billion in massive scale revenue. The market sustains a 50 times multiple on drastically expanded earnings. And remember, if you want to dig into the exact mathematical model to see the detailed assumptions for every single one of these scenarios, you can find the complete interactive framework in the research report at flash.stocksentinel.ai.
Next, we need to address the critical execution risks.
No investment thesis is bulletproof. To actually realize those base or bull case returns without catastrophic drawdowns, Arista must navigate some severely concentrated vulnerabilities. The absolute biggest threats are hiding directly in their supply chain. Arista has a non-negotiable reliance on Broadcom for their merchant silicon chips, and they rely entirely on TSMC in Taiwan for the physical fabrication of those chips. Because of advanced wafer constraints at TSMC, Arista is burdened by staggering 52-week lead times. They have to commit massive amounts of cash today to order parts for revenue they hope will materialize a year from now. If geopolitical tensions in the Taiwan Strait escalate, Arista's physical product shipments would grind to an absolute halt. They'd have the incredible software, but no metal boxes to put it in. Plus, relying on Broadcom means they have very little leverage if Broadcom decides to aggressively hike chip prices. Additionally, their enterprise campus expansion is highly sensitive to macroeconomic conditions. If corporate IT budgets tighten during a recession, campus network refreshers will be the very first line item CFOs cross off the budget.
But the most immediate vulnerability is right here. Their revenue is intensely concentrated. Microsoft accounted for 26% of total sales in 2025. Meta Platforms accounted for another 16%. That is 42% of their entire global business tethered to the capital expenditure budgets of just two companies. This is the Achilles heel of the thesis. As an investor, the early warning sign you must watch for is a shift in sentiment from these two titans. If Microsoft announces a cut in CapEx on their next earnings call, or if Meta decides to shift back toward in-house custom networking solutions, Arista's top line would face immediate severe compression. You simply cannot analyze this company without accepting that their near-term destiny is heavily reliant on the AI spending willpower of a handful of cloud giants.
Finally, let's look at the investment verdict.
Bringing this all together, there are three crucial takeaways you need to walk away with. Step 1. Open Ethernet is currently winning the AI infrastructure war because hyperscalers absolutely refuse to be locked into single-vendor ecosystems where Nvidia dictates the pricing. Step 2. That staggering $6.2 billion in deferred revenue provides incredibly rare hardware earnings visibility. It's a financial fortress protecting them from short-term cyclicality. And Step 3, their aggressive expansion into enterprise campus routing is delivering a highly profitable, stable, secondary growth engine to supplement the heavy lifting of the data center AI buildouts.
Going forward, the one vital metric you must watch closely on their balance sheet is their $8.9 billion in non-cancelable purchase commitments. Because of those 52-week lead times, management has legally committed to buying $8.9 billion worth of raw components today just to secure their supply chain. It guarantees they can meet future hyperscaler demand, but it comes with a massive catch. It risks brutal inventory write-downs and gross margin compression if cloud AI demand ever suddenly falters.
Ultimately, that $6.2 billion deferred revenue reservoir proves that Arista is already winning this fight. They are steadily pulling the hyperscalers toward open standards and securing their place as the indispensable central nervous system of the global AI buildout. But as the artificial intelligence race inevitably moves from building the expensive infrastructure to demanding actual software profits, the million-dollar question remains. Will the hyperscalers keep spending blindly on this nervous system, or is the ultimate hardware hangover just around the corner? If you want the full research, including the deeper framework behind this video, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.